So yeah, we're going to be having our bi-weekly whole life Twitter space where we delve into the world of infinite banking and cash management with whole life insurance with our expert team here at Infineo. So I'm honored here today to have experts in infinite banking, George Roth and Wayne Durksen. And yeah, George, Wayne, would you guys like to introduce yourselves for the listeners?
Yeah, so I'm George Roth. I'm the director of a Canadian agency here at Infineo. And so we have 20 plus agents across the country. And we also have an agency into the US, and we have agents down there as well. So happy to be here and really excited about this particular topic.
Yeah, thank you for being here, George. And Wayne?
Yeah, and I'm Wayne Durksen. I've been around this industry for a long, long time. And every day I get more excited as I think about how properly understood, this particular opportunity can be a game changer for individuals across the nation. And so get excited every day to work with clients and help them understand how to actually preserve and protect their capital and put it forward to build their wealth and advantage their families.
Well, I mean, that kind of just segues us perfect into the topic of conversation for today. And actually, what I have in front of me are a list of pros and cons of whole life insurance. And on that note, we hear, or depending on where you get your news from or financial information, you may hear a lot of pros or cons about whole life insurance. But we here at Infineo really believe in the power and benefits and its ability for cash management. And this is known as a process called infinite banking. And so we're not going to be one-sided here. We're going to look at a list of both advantages and disadvantages. But I think we really, correct me if I'm wrong here, George or Wayne, would like to start with the advantages of holding whole life insurance. And so, am I right there?
That makes sense. Yeah, absolutely.
Yeah, perfect. And so I have a list here, like I said, and the first one is equity creation and ownership, providing ultimate control for the owner. You are a shareholder earning dividends based on the profits of the PAR account, which means participating whole life insurance for those who are unfamiliar, and or the insurance company. And so, George, Wayne, it would be helpful for our listeners if you could potentially speak to the advantage of equity creation and ownership as it relates to owning a participating whole life insurance policy.
Sure, I can start, and then and I'm sure Wayne can add as well. So the first thing to understand is that participating dividend-paying whole life insurance is an asset. So it's an asset that creates equity. And with that comes ownership. And with ownership comes control. So ultimately what we want to do is take over control of our finances using this specific tool. And when we talk about ownership, not only are we owning the contract, we are also owning a piece of the insurance company if it's mutually owned, or we own a piece of the participating account, which is a segregated account within a stock-owned insurance company. And with ownership, as policyholders, we're only ones that get to benefit from ownership. That's what participating means, participating in the profits of the company. Because we are participating, we earn dividends. So every dollar that goes to the participating account is used to make more dollars. And then based on the profits of that company, we earn a dividend as the shareholders of either the company or of the account. So that is very, very important. Equity, ownership, control. And Wayne, you want to add anything?
Yeah, I think just to maybe give you what George just described, in Canada particularly, and I'm guessing in the U.S. as well, home ownership has become very, very common. Many people are stretching to be able to afford a home. But we want to own a home because we want equity. We want to own that home. We want to eventually exchange our mortgage payments for complete ownership of the property, which isn't easily achieved for particularly younger people across North America today because of the high cost of living and inflation. But owning a properly structured whole life policy is very similar. It's an asset, as George explained, that you can build equity in and own and control. And so you think about that. You may not be able to own a home right now, but everybody can own a properly structured whole life policy and fund it and build equity, get an outcome just like you have in your home, that someday you've got this asset that you can leverage, you can borrow against, you can upgrade, all kinds of features that are there because you've gained the right, because you own the access and equity in the system. And so just bear in mind, this is likely the very best asset we can own as Canadians and Americans.
Thank you for elaborating there, guys. And I just want to go and take a potentially a step back here for any of our listeners that are listening to the recording or listening live that may not be as familiar with whole life insurance. We typically have our chief economist here, Dr. Robert Murphy, renowned American economist, expert, who is also an expert and very well-versed on the economics of whole life insurance. He usually gives kind of a primer for us here, but we don't have him joining us. So George or Wayne, would one of you potentially explain the difference between whole life and just traditional term life insurance, which is what most people think of when they hear the word life insurance?
Sure. Very, very often people think when they hear life insurance, they think that there's a cost and I have to die in order to benefit. So they're trying to protect themselves from the eventuality of something catastrophic happening. So that's what traditionally insurance is considered, right? So they want to pay as little as possible and get as much protection as possible. And that is generally in the form of a term policy. So term insurance is exactly that. It is good for a period of time, a term, 10 years, 20 years, 30 years, whatever it may be. But the problem with term, and it has a purpose. There's nothing wrong with term insurance. It has a purpose. But if we want to talk about pros and cons, the problem with term insurance is that it will end. The term will end. And then when the term is up, you have the option to renew. And when you renew, it's going to be much more expensive because you're now that much older. So the cost becomes prohibitive. And often people will cancel their policy when it gets too expensive. So at the end of that period of time, they now have nothing. They have no protection and they have lost all the money that they put into it. So often, if you think of value for your dollar, that's not good value. Yes, you have been protected for that period of time in case of a catastrophic event, but you're not getting any value. Whereas whole life insurance is guaranteed for your entire life, regardless of how old you grow. And there's other guarantees that we're going to get to here in a minute. But that's the main thing. It's guaranteed for your entire life, and it will not go up in cost, but it will go up in value.
Yeah, George, you basically just hit my next two advantages of owning a participating whole life insurance policy in that explanation. The next one was going to be premium rates are guaranteed to never go up, and there's a guaranteed lifetime benefit. Wayne, anything to add on those two advantages of owning a whole participating whole life insurance policy? I can repeat them if needed.
I think just to jump on George's explanation, Bob Shields was an elderly gentleman I met a few years ago, and he wrote a book called You Don't Have to Die to Win. With term insurance, you do have to die to win. With whole life insurance, you do not have to die to win. And I think that's a pretty big distinction and advantage, and probably worth taking the time to understand. And that's a big part of what we do here at Infineo, is we educate people to understand what's actually happening with the flow of money. Money is always in motion. Whether we see it or don't see it, understand it or don't understand it, but don't believe it, money's always moving. And whole life insurance helps us begin to understand and pay attention to and track and have that flow in a direction that is to our advantage versus continually flowing away from us. And so hopefully that adds to what George said.
Definitely did. And thank you for adding that. And so a piece that we haven't really gotten into yet, but I think that you started to hit on there, Wayne, is that you have to die to win with term insurance. But with whole life insurance, they're what we like to call the living benefits. And this actually takes me into my next advantage, which is the guaranteed and increase in cash values with uninterrupted compounding interest. Your capital is preserved and all your gains are locked in, making whole life insurance a stable, predictable asset that pays you, all built in on the foundation of contractual guarantees. What do you guys have to say to that benefit?
Yeah, if we go to the guaranteed aspect that we touched on, so the premiums are guaranteed never to go up. That's one guarantee. The second guarantee that you mentioned is that the death benefit is guaranteed never to go down, and it will be there for the rest of your life. The way we structure these policies is that the death benefit will also increase over time. And on the living benefit side, there is a guaranteed cash value that is guaranteed to grow every single day without fail. It can never go down and it can never be zero. And once the growth is locked in, it is there for the rest of your life. So those guarantees make this product extremely attractive. And when we think of inflation, just try and name one asset that is guaranteed never to go up in cost and is guaranteed to always go up in value. So steady cost, increased value. I don't think there's anywhere else where you're going to have that kind of hedge against inflation. So those are very attractive guarantees that come with whole life.
Wayne, do you have anything to add to the guaranteed cash value component?
Yeah, well said by George, but I think just for our listeners to think about this, you're taking a dollar today that has absolutely been eroding for very many years and will erode over time. You're taking a dollar today and potentially buying an asset for that same dollar well into the future. And in some cases, we're dealing with infants. They're talking 85, 90 years into the future. What will that dollar be worth given the erosion of inflation on our money? And so this is no small deal for people to pay attention to. Because our premium is fixed, we're buying an asset today in today's dollars that will grow exponentially in the future. So as George pointed out, where can you get a hedge against inflation like this and a guaranteed growth with a no loss provision built right into the contract? It's, when properly understood, it's absolutely astounding.
Thank you for adding there, Wayne. And so if you're already hooked and you're ready to talk more about getting your whole life insurance policy with George or Wayne, or just want to learn about the ins and outs of whole life insurance a little bit deeper and ask all your own questions and get them answered by our experts, what you can do is click the pinned tweet there and click the link for your country, and it'll allow you to schedule a call at your convenience. So we highly encourage you to do that. You can do that at any time. Those links aren't going anywhere. So if you're listening to the recording, we highly encourage you to check those out. And with that, for any of our live listeners, I've pinned a tweet before that. If you have any questions about anything we're talking about, please feel free to put them under there. We're not going to be taking any people up on stage, but if you do have any questions about anything we're talking about, please feel free to put them there and I'll pass them along to our panelists for you. And so with that, there's a component that not a lot of people know about whole life insurance. I've even spoken with people that own whole life insurance that don't know that this is a component of them. But the advantage of the liquidity aspect of whole life insurance. So I won't go into it too deep and steal your guys' thunder, but George or Wayne will, why don't you guys explain the advantage of the liquidity being available in owning a whole life insurance policy?
I'll let Wayne go first this time.
Yeah, so I think for many people, when they're thinking about some purchase that is yet to be made that they're waiting upon, they have to keep their money liquid. They have to keep it available. Therefore, they don't have the luxury putting it into a term deposit, or some investment structure, or into a market that is volatile and potentially could drop. So they need to leave it sit someplace that is available to them. Therefore, they're not likely going to earn any rate of return on that dollar while it's sitting there. And it could sit there for a long time. Inside corporations, we see this happen all the time. They've got potentially large sums of money sitting in their checking account or their bank account, waiting to fund off operation costs or opportunities that may come. All the while, that money has to be sitting there uninvested because they need it to be liquid. Liquid simply means accessible instantly. Inside a properly structured policy, your cash value would all the time while still earning a reasonably good rate of return, which becomes a bit of a distraction. But having that dollar sit there that is accessible and available to you anytime with a simple phone call is a tremendous advantage. And for people that store their capital inside these structures and understand how to leverage it and use it and replenish it, it is a profound tool in their toolbox, their financial toolbox of operations.
George?
Sure. Yeah. Just to add to that. So the liquidity is very important. The other thing is it's unstructured. So you dictate the term on the use of that liquid cash. So what we do is we collateralize the cash value. So we leverage the cash value and the dollars physically come from the insurance company. So our cash stays inside our policy and continues to grow as if we did nothing, yet we get to leverage it and then put those dollars to work second place. So Wayne talked about dollars without a job. So first, we want to give our dollars a job, but we also want to give them more than one job. So we're going to give them the job of growing inside the policy. Then we're going to give those same dollars a job after we collateralize that cash value. And we choose which job we want them to do. We can invest those dollars somewhere else. We can take advantage of opportunities. We can pay off debt. We can do any number of things with those dollars. So now we have the dollar working in two places. In addition to that, we also have that lifetime legacy that we've created. So we have our dollar working in three places, and that all of those things are guaranteed. So when we talk about guarantees, we have guaranteed access to our cash value. It's written right into the contract with the insurance company. So guaranteed liquidity, uninterrupted growth, and we get to give our dollars at least three jobs at the same time.
Great. Thank you, guys. I was looking to find Dr. Murphy's article comparing buy term invest the difference to whole life insurance, because on that note, I mean, that really is one of the biggest aspects, in my opinion, of whole life insurance versus buy term invest the difference. And we don't have Dr. Murphy here to hit on it. Guys want to real quickly potentially hit on that objection, or should I move on to the next advantage and we can address that potentially in the disadvantages section?
Well, let's just briefly chat to that. Buy term invest the difference was popularized by Art Williams back when interest rates in the 80s got extremely high, and you could get 9 to 12% on a GIC, and whole life insurance became what appeared to be an expensive way to buy death benefit. Again, if we understand what was taking place, there was a significant misunderstanding happening in the midst of that. But nonetheless, reality says people really bought into the buy term invest the difference, theoretically suggesting that at some point in the future, you will have no need for a death benefit, but your cash will have grown. So there's all kinds of questions in there that maybe I won't delve into at this point unless George chooses to, but there's tax implications with that. And so while you could see the numbers, I did the numbers. I was a big advocate of that buy term invest the difference in that era because of my ignorance and lack of understanding of how the whole life insurance structure actually works. But today we've got a few proponents suggesting you can still get a solid 12% inside a mutual fund. And I'm saying, show me where you're getting a solid, consistent, fairly reliable, and relatively safe return of 12% in a mutual fund. We've just been through a really good cycle in the market, and that wouldn't even be true for most people today. And so the reality is we need to compare apples to apples if we're going to have these conversations. And so the other thing that I find quite fascinating is the theory that we would have no need for death benefit in the future. And I'm saying, have you ever had a terminal tax return with a tax issue? I know people that have significant tax consequences from success or wealth. Boy, how nice would it be to have a tax-free death benefit become available to help offset your tax liability, which isn't going to be ignored. And so buy term invest the difference theoretically can look really good on paper, but when you understand the comparison of what you can do inside a properly structured whole life policy and how it can advantage you tax-wise and growth-wise, and it's really your behavior that grows or maximizes the potential of your cash value and your death benefit, as George pointed out a bit earlier. And so this is a great conversation. It's worth people wrestling with a little bit and unpack it. There's no resistance on our part to say, hey, there's an idea here that you probably do need to think through and understand. But at the end of the day, I would go back to what I said earlier. Properly structured, participating, dividend-paying whole life insurance policy is the single best asset individuals or corporations can own in their portfolio.
Yeah, I'll just pipe in there, Jackson. That was awesome, Wayne. That was very well said. The other aspect of that is, buy term, invest the difference. You have to actually invest the difference. So there's the financial aspect. There's also the psychological and emotional aspect of this. What if you invest the difference? What if you only invest the difference for a while or partially? So are you going to get the growth that you expect? anyone can say you're going to earn 12%, 10%, 5% over the next 50 years. Anyone can say that. But how close to reality is that? Because the markets, they tend to go up, but it all depends on when you get in and when you. So there's so many different moving parts and aspects. I call it the pray, wish, and hope strategy. We hope our money's going to go up. We hope our money's going to be there when we need it. We hope that we're going to be able to pay that tax bill upon death. All our assets are deemed disposed of when we pass away at fair market value. So based on the fair market value of our assets compared to the cost of those assets, we're going to have capital gains. Often, when people are settling their estates, or the estates of their parents, etc., others, the tax bill is enormous, right? You can lose 40 to 50% of your estate just going towards taxes and fees and costs associated with probate and settling the estate. So if you have a tax-free death benefit that you can use to potentially offset that tax bill, that becomes enormous. In addition to that, if you want to leave a legacy for the next generation, the life insurance gives you permission to now spend your money where you have it in other places. If you have invested your money wisely and it has done well, you can now spend it knowing that you're going to leave a legacy to the next generation, tax-free, regardless of what happens in the market. So there's a financial aspects to it, and then there's a psychological and emotional that also have to be considered.
Just if I can jump in just quickly and give a real life example. So my wife and I own a cottage, and it's been a family dream, and we've enjoyed it immensely. We've had it since our kids were little. We now have grandchildren enjoying it. But if my wife and I were to be tragically removed from the planet on our way to Phoenix this weekend, my kids would have to sell the cabin because they could not afford to pay the capital gains tax that is currently owing against it, outside of the fact that I have some tax-free death benefit coming their way to offset that tax liability so that cabin can stay in our family. Otherwise, they would have no choice but to sell that asset to pay the tax liability or use some other asset that might come to them in our estate to offset that tax liability. And the second thing, if I can just throw this in because I'm a bit of a one-trick pony, a properly structured participating dividend-paying whole life insurance policy is not an investment, even though it performs remarkably well. It's an alternative place to store our capital until we find an opportunity to seize upon, and then we actually jump. So it's our behavior in leveraging and utilizing this structure as one of our core assets, as our savings account, as our liquid account, as our opportunity account. Again, really important for people to understand that this has been a misunderstood product. And I know that for sure because I seriously misunderstood it prior to meeting Mr. Nelson Nash.
Guys, you guys are getting way ahead of me here on all these advantages. You guys just knocked out, I would say, probably 5 or 6 of the advantages that I was going to be able to bring up. But that is also eloquently put and a lot better than me just reading these pros and cons off a list. So thank you. With that, I think that we can move on to the advantage of policy loans being interest-only loans for the lifetime of the contract, if you choose. I'm not honestly as certain about that one myself. Can you guys potentially speak to that? The policy loans being interest-only loans and that being an advantage of whole life insurance policies?
Sure, I can speak to that. So as we kind of alluded to earlier, the policy loan, you dictate the terms. So you can pay it back right away, you can pay it back monthly, or you can pay it back never. So if you pay it back never, there will be interest that does accumulate because you are using other people's money. And then when you pass away, that loans will come off the death benefit, and then the net amount will go to your beneficiaries tax-free. So if you wanted to, you have the option to treat those policy loans as interest-only loans if you choose. It's your choice. Again, with ownership comes control. You get to dictate the terms and conditions. So it's just an idea or a thought or one of the options that are available to make it a interest-only loan. Therefore, the interest does not compound upon itself. So that's just one option that is available.
when would someone be interested in taking out an interest-only loan, like traditionally?
Well, there's probably a multitude of reasons, and I will give you one thought. But suppose you see an opportunity that is just too good to pass by, but you're saying right now my cash flow is a little bit, and I may not be able to fund a repayment structure of principal and interest. I can jump on that opportunity and seize upon that, knowing there is no responsible obligation on me to make any kind of payments on my policy loan. As a responsible policy owner, I'm going to want to come up with a strategy to say, I'm going to figure out how to at least cover off my interest costs. But even if I can't, I've got the opportunity, it's working for me, and I don't have any obligation or expectation from the insurance company to make any kind of payment on that policy. And in the event that I kind of get upside down on the deal, eventually I'm going to pass away and they're going to deduct whatever is outstanding on policy loans from the death benefit before they transfer that to my estate or loved ones. And so there's a multitude of reasons why we may choose not to pay a policy loan. But there's one example that I think is pretty prominent for many people.
I think also when we talk about traditional, so traditionally people often will use real estate, right? So real estate as an asset grows in equity. Theoretically, it will grow in equity. And then we can use that equity for something like a home equity line of credit. And often those kinds of things can be interest-only payments as well, if you choose, right? Again, it's your choice. You decide. So there are some similarities there. I wouldn't say it's exactly the same. There's no guarantee that your equity is going to go up in real estate, but certainly there is a guarantee that your equity is going to go up in a participating whole life insurance policy. So some similarities, but some key differences as well.
Thank you, guys. And Wayne, actually, in your statement, you kind of started to allude to our next advantage of a whole life insurance policy when you said the statement, a good policy owner. And so I, again, not going to steal your thunder, but the next advantage is that with discipline, a whole life insurance policy can become a forced savings model. And so do you guys want to speak to that and how that can be an advantage of owning a whole life insurance policy?
So I often tell my clients, your savings vehicle should be a properly structured policy. It's a far better place to store your capital and your cash. And opportunities will always show up, whatever they are. They will always show up, and you want to have your capital available to you to access and have it liquid while still growing and multiplying, growing your wealth. And so, I think it's a tremendous place to store your savings accounts. And for many people, when they start to realize, I'm storing my savings account right now in a checking account that is advantaging the bank in profoundly significant ways, why would I not look and say, can I put that inside my own structure that I own and control and have complete access and control over, and allow that to benefit me rather than someone else? I think that's a pretty profound reason to consider this our primary savings vehicle.
And I think it's key too there. Excuse me. So when we talk about, buy, turn, invest the difference, well, what if we don't invest? So it takes discipline either way. In this regard, once we set up a contract, there's a minimum that will be required either monthly or annually. And you want to be disciplined and committed to making that minimum payment. And that is, you could consider that a forced savings plan, right? You've now made that commitment and you are committed, and the money will be taken out of your account before you even know it, before you even think about it. And it comes with those guarantees that we talked about, right? So it can become an excellent savings tool. And it's important to understand the difference between savings and investing. Savings comes with guarantees. We know the money's going to be there when we need it. Investing comes with the risk of loss. And it doesn't matter what you invest in, there's always a risk of loss. Absolutely, there's a potential for gain, but you have to be able to accept that risk. And what if the money's not there when you need it?
I could add to that as well, George. Just think about a vehicle loan. You either save up and pay cash for your vehicle, which has been talked about in the previous episodes. We finance everything we buy. We either borrow money from someone else and pay it back with interest, or we spend our cash and lose the potential growth on that cash that could have happened had we had it properly invested or stored somewhere. And so with a vehicle, if you pay cash, immediately you have to start saying, well, this vehicle will wear out one day. I need to replenish my savings account so I'm able to replace my vehicle when that time comes. Well, the same process happens inside a properly structured policy. So Now, instead of paying cash, we're going to leverage that and we're going to replenish the pool. So just understanding the movement and the flow of cash is really, really important, the flow of money in your life. And having it inside a structure you own and control with all kinds of advantages builds your wealth, whereas storing it inside a bank account does benefit the bank. It does not benefit you, but it is a safe place to store your savings account while you're waiting to make major purchases. And so again, just understanding that it's kind of both, and we get to have it and we get to use it and we get to benefit from it and we get to have it come back to us sort of in spades, recapturing all the dollars that typically flow away from us and restore them and build our own wealth. So again, it's a tremendous place to store your savings dollars.
Thank you, guys. And so on that note, there are just so many advantages of whole life insurance, and we at infineo will talk about them with you all night. And so if you are interested in hearing more of these advantages, or you have questions about anything we've said, please book a call at the pinned tweet. Just click the link that is for your country and book a call at your convenience with one of our experts and get any of your questions answered, or get yourself set up with a whole life insurance policy. And our experienced agents will help you and hold your hand all the way through and make sure you have someone to answer your questions every step of the way. With that, we did have a couple more advantages that I can just highlight briefly. You don't have to dive into them. Just for the sake of time and keeping things balanced, I do want to transition to the cons. But the advantages that we haven't been able to hit that we were going to are the longstanding history of whole life insurance. It's been around for 173 years. And potentially even longer in the United States. That's just for Canada. And so it's a very sound financial asset. By design, participating whole life policies are involatile. They're not correlated to any sort of economic or geopolitical risk. Additionally, it's a contract between the owner and the insurance company, which creates a layer of protection from creditors and judgments. And additionally, as we've started to hit on, your wealth must reside somewhere. And by keeping it in a warehouse you own instead of one owned by someone else that's working for them, you're going to get all those benefits instead of it working for someone else. So again, if you are interested, please book a call. And with that, let's move into our cons or disadvantages section. And so with this, the most typical objection to whole life insurance is the premium. Looking at my list, it reads, initial premium costs are typically higher than term insurance. This is the cost of ownership versus renting. On the other hand, over the long term, whole life insurance can be less expensive than term, and it never expires. This is especially true with a child's plan. So can you guys potentially just speak to the cost objection that is very, very common when people see the premiums on whole life insurance?
Yeah, absolutely. So Wayne says this all the time, and I love to steal this. Cost is only an issue in the absence of value. Cost is only an issue in the absence of value. So let's talk about value. Term insurance versus whole life insurance. What are you getting for term insurance policy? What are you getting for a whole life insurance policy? Dollar for dollar, the value with whole life is much, much greater. Much less risk associated, and you have the long-term benefits. It never expires. And Wayne alluded to this earlier, because once we lock in our price point, it stays there for the rest of our life. So if we do this for a child and we think about how much are we going to pay for life insurance on a child, it's very, very inexpensive. But we're locking in that price point for the rest of their life. They're going to pay the same premium when they're 1 year old as they are when they're 85 years old. Think about that for a minute. Whereas with term insurance, the cost goes up over time. So as that cost increases over time, and if we do a dollar for dollar comparison, the term is actually going to cost more in the long term if we keep it. So term insurance is designed to expire before you do. Less than 2% of term insurance policies ever pay out. So think about that. Where are you putting your dollars? Is it good value? And where would you want to store your money with less risk?
I think, again, if I can add to that, think one of the reasons people feel, well, this is very expensive compared to what I can get in term, and therefore you go back to George's comment about the cost is only an issue, the absence of value. The other issue is that we've made other decisions. We've made decisions that have implicated some of our available surplus cash flow. And so now we're trying to stave off an expense that we would rather not have. And I'm saying, well, if we have the discipline of understanding the most important thing we can do with our paycheck is pay ourselves first, not last, because there may be nothing left at the last. So getting the discipline of getting your paycheck, let's just say you got $1,500 came in this pay period, to pay yourself $200 off the top and put it somewhere, rather than say, wow, there's we're running a little tight right now. The reason we run tight is because we haven't really sat down and planned out our financial future. And so, yes, a properly structured policy is more expensive than term, but you're not even remotely talking apples to apples, as George pointed out. And understanding the features. I mean, my little grandson is turning 5, and so on Saturday we were at Cabela's buying him a fishing rod and reel, and the reels were just there. The reels were just under $100 that I was looking at for him, and I wanted to know the differences. And so the store clerk began to explain, well, this particular reel has this feature and that reel has. And I'm looking and saying, wow, for the extra money, those features just aren't worth it. So I bought the less expensive of the two. But when it comes to a policy, we need to understand, hold it a second, that is a really good value that I do want to grab hold of while I still can. And so, yeah, premium's an issue, but it's only an issue because we don't always, we haven't done our planning well, we haven't had our disciplines in place. And best time to plant a tree, it was a long time ago. The next best time is today. And so understanding how do we structure our worlds, our financial worlds, to advantage our own person and lives and family and future.
Can I just jump in there? Sorry, Jackson. The other thing that I'd like to touch on here with this aspect is cost, the idea of cost. So this is not really a buying decision. The decision is not to buy whole life insurance. The decision here is I want to take money from one account, put it into another account. I only control both accounts, but second account, my whole life policy account, has way better features than my first account. It's really what we're doing here. We're transferring money from one to another. We're putting it in a place that gives us 17 advantages. So it just makes a lot of sense, right? If we look at it as a cost, it's the wrong way to think of it. It's not a cost. It's a transfer of money into an account that we own and control.
Guys, you're really, really killing it here. I'm loving all these explanations. And so with that, the next disadvantage of cons or a disadvantage of owning a participating whole life insurance policy would be that the withdrawals of cash value reduce the long-term growth and cannot be repaid to the policy. Can you guys explain what that means and also potentially give your rebuttal if you have one?
Sure, I'll start with that one. So there are different ways to access the cash value inside the policies. We've talked about the loans and using leverage, but the policy owner does have the option to actually withdraw cash value. So you can physically withdraw your cash value. There is that option available. If you choose to do that, the disadvantage of doing that is that going to impact the growth because it's just like a savings account. If I take money out of my savings account, it is no longer going to grow for me. It can't grow. It's not there. So the same idea. So we're going to impact the long-term growth. And the other disadvantage is that we can't replace that money. So once we withdraw it, we can't actually replace it. Whereas if we leverage, use a policy loan, we can replace those dollars and then use them over and over and over again. So we're recycling our money through our policy as it grows in value over time.
And part of the significance of that is that people don't think long-term enough. So I was talking to a group of high school students a few years ago, and I said to them, how many of you go to Starbucks? And so, yeah, they go, and let's just say you're buying a $5 coffee. Well, today, in grade 10, that coffee cost you $5. But what you don't understand is that if that $5 was put on assignment at 5%, it would grow to $168 by the time you're 65. And so you killed $163 of your compounding. So when we actually pull money out of our policy as just a cash out, we have hurt our wealth building system incredibly without even being aware of it. So oftentimes we're simply ignorant, and we need to educate ourselves and understand what's happening. And so all of a sudden you start to think very differently when you take control of your finances. And so I say this all the time. Let me say it again in this episode. Leaders, as it applies to individuals, but take responsibility. They do productive things, they make difficult choices, and they serve other people. And so when you think about that financially, we need to take responsibility. We need to do some productive things with our money. Then we need to make some difficult choices, delayed gratification, and even how we go about accessing, utilizing leverage, and growing. These are profoundly important and consistent principles when it comes to our lives and when it comes to our finances.
Thank you, guys. That was a perfect explanation, and I definitely agree with what you guys said in terms of explaining your guys' rebuttals. So thank you. And with that, our next disadvantage will be that policy loan interest rates may often be higher than loan interest rates elsewhere. Can you guys explain that?
So I'll take a shot at that and protect me, George, from my own zeal. But one of the things that we don't think about is we don't think about long-term behavior of our wealth. And so understanding that when we put money away, and this is what I want to sort of say, George might have to protect me a bit. The rate of interest is a distraction. That's a direct quote from Nelson Nash. The rate of interest is a distraction. The volume of interest is what we should be paying attention to. The rate of interest often trips people up. And so I love to ask people, and particularly I love to ask bankers this question: is it possible to pay more on our borrowed debt dollars than it is to earn on our savings dollars and get ahead? Is it possible to earn less money on our savings account than we pay on our debt and actually get ahead? And I'm saying absolutely and profoundly, significantly get ahead. So now, if you're human, you probably say, well, now this guy just completely lost me. That doesn't even make any sense. And it doesn't make sense because we've not been invited, challenged, and encouraged to do the math. But when we do the math, it makes a significant difference if we have those dollars leveraged with uninterrupted compounding over a long period of time. And if we continue to interrupt the compounding, it really hurts us. And so when it comes to our debt, we might have a 5-year loan at 7% while we're only earning 4% on our dollars invested or in our savings structure. And I'm going, absolutely. If you look at your balance in your savings account inside your structure over the course of your lifetime, it's going to do extremely well, whereas that debt might have been a 5-year window. When you actually understand what's happening, you will know what to do, but that can be an annoying statement. But part of our challenge at Infineo is how do we help our clients learn and understand so they can make informed choices and get ahead of the traditional system that is really taking advantage of our ignorance and hurting our financial wealth building system and ultimately our loved ones and our beneficiaries.
Yeah. Can you guys hear me okay?
Yep, I've got you all right.
Okay, perfect. Thanks. Yeah, so well said, Wayne. Just to add to that, so higher interest rates with a policy loan versus a lower interest rate at a third-party lender. It is possible. However, currently, one of the insurance companies that we work with here in Canada, Equitable Life of Canada, their policy loan interest rate is 6.5%, which is actually less than prime right now. So it may be higher, it may be lower. But again, as Wayne said, it's not about the rate, it's about the volume. What is the volume of interest they're paying versus the rate? The rate can be very distracting. The other thing to this is, as we talked about earlier, we are owners of the account. We have shared ownership of the participating account and or the insurance company. So any dollar that we put back into that company is going to come back to us indirectly in the form of a dividend. Because we are the owners, the policyholders, the shareholders, we earn a dividend based on the profits of the company. Dividend is not guaranteed. However, the companies we work with have never, ever missed a dividend in their entire history. Last 175 years in North America. You know, whole life insurance has been around longer than Canada's been a country. longer than we've had income tax. So anything that we can do to benefit the company that we own is going to benefit us. So instead of using someone else's financial system or account and benefiting them, let's use our account that we own and control as a shareholder and benefit ourselves instead of someone else. So yes, we may have a higher rate on our policy loan. We may or may not. It's not necessarily going to be higher, but every dollar we put back in is going to come back and benefit us in the long term.
Oh, I was on mute and just talking to mute. So thank you so much for your guys' insights there. And it looks like we lost George. I was just saying how that disadvantage actually does turn into an advantage, like George was just saying. Even on my disadvantage here, they start to talk about how the policy owners are shareholders in the insurance companies who get dividends. So you're indirectly benefiting by paying the interest in a policy loan instead of using a third party. So thank you for hitting on that, George. Our next disadvantage here is going to be that any loan interest, if not paid, will compound and be added to the balance of the loans. Can you guys speak to the potential disadvantage of that in a life insurance policy, in a whole life insurance policy?
Yeah, so anytime we have accumulating interest, compounding on interest, that's just not a good decision financially. But it's doable, it's allowable, it's possible. But you are actually hurting your own wealth building, even though in the long run, inside a properly structured policy, it's far more advantageous than being in the traditional system of a checking account. So learning how to understand that our dollars have value and they should be treated well. And if we're going to leverage them on an opportunity, we should treat them well. Probably don't have time to unpack this today, but it's a concept called economic value add, or EVA. Dollars are dollars no matter who owns them. So if you own them, you should be able to treat them exactly as you would dollars you borrow from a different lender. That lender's going to have expectations. We probably have need to have the discipline of having some of its expectations on our own. And so, again, stolen from becoming your own banker, be an honest banker. Don't steal the peas. You should probably get a hold of the Becoming Your Own Banker and read that to discover what exactly Nelson meant by don't steal the peas. But that's in essence this concept right here, is making sure that you replenish your policy loans so that they're available to be utilized again and again and again. If we run a policy loan and we don't repay it, which is our right, we don't have those dollars available for the next opportunity. And money must reside somewhere. So why would you not have it reside inside your own structure? Because money is always in motion and flowing. You're earning money yesterday, you're earning money today, you're earning money tomorrow. It's all about discovering what's happening and then practicing the discipline and making sure that you're honest in how you operate your own system, because you wouldn't be crooked in your own system, hopefully. So don't rob yourself and don't rob your families.
And I think just another aspect of that is how that interest is calculated, right? So normally a loan, whether it's a credit card, a mortgage, or a car loan, whatever it is, there's compounding interest, right? It can compound monthly, it can compound semi-annually. So you're paying interest on top of interest regardless of your payments. Payment structure is designed such that your interest being charged to you is compounding. Whereas a policy loan, it is not compounded over the course of the year. And this is a policy year, not a calendar year. It is not compounded, but it's capitalized on your policy anniversary. It's calculated on a daily balance. So if the balance goes up and down over the year, that's going to change the amount of interest that's calculated. And then it is capitalized to your policy loan on your anniversary. So again, if we kind of go back to the idea of interest only, so as long as we make sure that we pay at least the amount of interest over that course of that year, we can ensure that interest is not going to compound upon itself. So absolutely what Wayne was talking about is true and accurate. In addition to that, it's how that interest gets calculated in a policy loan that is different and even makes it more attractive.
Beautiful. Thank you, guys. And again, very well explained. And I think that we're coming up on time here. So we really only have time for one more con or disadvantage of owning a whole life insurance policy. And I've heard you guys speak on this one before, and so I'm actually excited to hear you guys speak on it again, because I love what you have to say. And The disadvantage here is that it is a long-term strategy that requires discipline and making educated decisions. A knowledgeable coach is essential. And so really just I'd love to hear you speak to the fact that this potentially isn't for everyone, and that it really is helpful to have someone that can be by your side, that one has done it themselves, and two is very well versed on the industry.
Yeah, for sure. So one thing that Nelson always taught us was, once you know better, you're going to do better, and you don't know what you don't know, right? So that's where a coach comes in, right? So we're here to help educate, mentor, and guide, but you are the owner, you have the control, you do the work, you make the decisions. And it is a long-term strategy. So some people think of this as a commitment and it takes too much time. So if we talk about disadvantages to owning our whole life, that would be kind of what I would surmise as the disadvantages, is that it is a commitment and it does take. However, anything that's worthwhile takes time and effort and discipline. So is it a disadvantage? I don't know. There is no get rich quick. If you think there is, you're in trouble. So it is long-term, does take discipline, does take education, does take coaching and mentoring. And then we're here to provide all that. So we can help solve those problems. And then, just in summary, so we talked about advantages and disadvantages. I have been doing this a long time. Wayne has been doing this a long time. I've come up with 17 advantages and 5 disadvantages. And in essence, when we talk about the disadvantages, are they real disadvantages? That's even debatable, because all of those disadvantages that people normally think of are not real disadvantages, in my opinion.
I completely agree, George. And even in reading most of the disadvantages, I think that becomes pretty apparent, especially with your guys' rebuttals. And Wayne, what did you have to add there?
I think the other piece I would just kind of throw in as a thing to pay attention to is that owning one of these contracts is actually a privilege. You have to qualify to own one of these policies. They're only looking for people that have good health and good lifestyle, because they're looking for the cream of the crop, the best risks, because they want this thing to prosper and flourish. And so paying attention to that, when is your health at its best? Probably today. When is it likely to deteriorate? Somewhere in the future. So, understanding that one of the disadvantages is waiting until you're no longer healthy enough to qualify, or some tragic issue. But I think we just have to pay attention to the fact that it's worth educating ourselves, getting a coach, and learning how to put this in place. And probably shouldn't do it until you understand it fully. But you should probably bump up the urgency on your level of awareness and knowledge so that you can make a really solid, informed, wealth-building decision.
Guys, this has been an incredible space, looking at both the pros and the cons that aren't really cons of whole life insurance. And so if you guys are inspired and want to take the next steps, again, please just swipe to the right once and go to the pinned tweet, and you'll be able to book a call at your convenience with one of our trained experts that will coach you every step of the way. And I just want to remind you guys that we have a weekly Twitter space. We alternate topics between real-world asset tokenization and whole life insurance, cash management with whole life insurance more specifically, also known as infinite banking. And so next week, we have a space coming up with Copper HQ. Copper is an institutional custody solution in the Web3 space, and we're going to be talking about the importance of custody, of sound custody more so. And so if you're interested in joining us, you can go ahead and look at the tweet right now, the one that's right there. No swiping. If you went to the calendar, you can swipe back to your left and it'll be there. And you can set your reminder by clicking that link. We really, really hope to see you there. And yeah, thank you, George and Wayne, for joining us today.
Thanks, Ken.
Thanks, Jackson.